Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at stock.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, so when we look at the core of what's been happening, the story seems very clear.
It is. Stock has really hit a fundamental inflection point.
And this wasn't just, a single good quarter.
Not at all. The third quarter of 2025, that marked 4 straight quarters of operational profitability.
Which is a massive signal to the market for a company that was, for years, really focused on, let's say, growth at any cost.
It's the sign of a disruptor maturing, really. And if you look at the raw numbers, they are, well, they're dramatic.
How dramatic are we talking?
Total revenues jumped 55% year over year. That landed them at $156.9 million.
And that wasn't just meeting expectations, was it?
No, it sailed right past what the analysts had modeled. It tells you their scaling efforts are finally paying off. Big time.
And the margin performance, that feels like the most crucial piece here. Revenue is one thing, but profit is another.
Exactly. They delivered $36.9 million in net income for the quarter.
That's a huge swing into the black.
It is. And the adjusted operating profit margin, that number came in really strong at 23.4%.
So that shows real operational leverage. As they get bigger, it's getting cheaper for them to run the business relative to the income.
Precisely. They're showing really effective management while maximizing the revenue from all that trading volume.
Which brings up the core question. What exactly drove this? Was it just the market lifting everyone up, or did they do something specific?
It was a bit of both, but their structural advantage was key. We saw this growth fueled by two main things.
Okay.
First, a big increase in user engagement. People aren't just opening accounts and letting them sit there.
They're active.
Very active. And second, much higher equity and options trading volumes. So while the market recovery helped, stocks focus on more complex tools, let them capture higher value trades.
And analysts have responded to that.
Oh, absolutely. They've materially raised their earnings guidance for 2026, which signals confidence that this isn't just a flash in the pan.
That's fascinating. It really suggests their competitive moat is built on something more than just, low fees.
It has to be.
So what is that edge? Let's dig into what makes their platform so sticky.
Well, their strength lies in these low-cost, tech-driven solutions. They have a strong brand identity, for sure, but the real differentiator is their investment in AI-driven tools.
What kind of tools?
Things like real-time data, advanced charting, personalized trading insights. It keeps them ahead of the legacy players who often have much more basic interfaces. They're attracting a more sophisticated retail trader.
And that innovation is translating directly into asset accumulation, right? The metrics I saw were staggering.
They are. Customer assets soared 84% year over year.
84%.
And just think about that volume. Their total customer assets are now sitting at $21.2 billion. That's some serious user trust.
It's not just the total assets, though. It's the new money coming in.
You're right. It's the net new assets. In Q3 alone, net new deposits hit $2.1 billion.
Wow.
That metric shows sustained active confidence. People are choosing stock as their primary platform to park new capital. It shows they believe in the stability and the future here.
And on the inside, it seems like they're building a fortress.
A very healthy balance sheet, low debt, which is crucial for a company that's still expanding so aggressively.
And that strong free cash flow, that's the fuel they need for new products and innovation without having to go ask for money.
That financial flexibility is actually a perfect bridge to their more strategic moves.
Yeah.
Because while they're growing, they recently did something to give themselves even more financial optionality.
Right, the supplemental prospectus. That detailed a standby equity purchase agreement. For our listeners, that might sound a bit technical.
It sounds technical, but it's basically a strategic safety net.
To explain that, what does it allow them to do?
It lets them sell up to 75 million new shares to a pre-approved investor, but only as needed. They aren't selling now, they're just setting up the mechanism.
So it enhances their liquidity for the future.
Exactly. If a big M&A opportunity comes up or they need cash for a huge expansion, they can get it quickly. It's smart preparation.
But there's a flip side.
There is. It represents potential shareholder dilution down the road if they actually use it.
Okay, so that leads us right into the biggest concern for this whole sector, risk. Specifically, their reliance on payment for order flow, or PFOF.
The big one.
Yeah. For many listeners, PFOF is kind of a black box, but it's the engine behind zero commission. Why is it such a risk?
Well, PFOF is the revenue they get when they route customer orders to specific market makers, who then pay a tiny fee for that order flow.
And that's how they can offer free trades.
That's the model. The risk is profound because that revenue stream is under continuous and pretty intense regulatory scrutiny, especially in the U.S.
What's the specific threat there from regulators?
They're concerned about conflicts of interest. The question is whether traders are really getting the best execution price.
And new rules could change everything.
They could. New rules might force competitive auctions for orders or even restrict the practice entirely. If that revenue stream gets squeezed, they'd be under massive pressure to find a new one, and fast.
So they have that sector-specific risk, PFOF, plus the broader economic headwinds.
Absolutely. Macro factors like interest rate volatility are always a concern.
Right.
Brokerages do benefit from higher rates on uninvested cash. But if the Fed makes sudden moves, it can really hit investor sentiment and trading volumes. So they're juggling this micro-regulatory threat and a very unsettled macro environment.
Okay, let's shift from the fundamentals to the technicals. How is the market actually pricing all of this in? As of mid-November, the stock has kept a pretty bullish trend.
It really has. The price action has been, you could say, textbook bullish, consistently higher lows and higher highs.
And what are the key levels?
Technically, the stock is trading comfortably above both its 50-day and 200-day moving averages. For long-term investors, being above that 200-day is that classic confirmation of a sustained upward trend. The market is clearly rewarding that profitability story.
So looking out over the next 3 months, what do the projections suggest? Where's the support and resistance?
Our analysis points to strong technical support right around the $15 level. That's where buyers have historically stepped in. The key resistance to watch is $19.
And a breakout above that?
A breakout above 19 is seen as highly probable if this momentum continues. It would really open up a new price ceiling for this stock.
What about the momentum indicators? Is the stock getting overbought? Is this run getting tired?
Not yet. The key indicators, like the RSI and the MACD, they're showing healthy bullish momentum. Crucially, they are not in that extreme overbought territory.
Which suggests there's still room to run.
It does. It suggests the stock is accumulating value stably, not just spiking, which usually comes before correction. It implies there's room for more organic upside.
And who's doing the buying? Is this all retail excitement, or are the big institutions getting involved?
It's a mix, but the institutional interest is definitely accelerating. We've seen positive insider buying trends.
Which is always a good sign.
A great sign. Executives are increasing their personal stakes. And beyond that, institutional inflows are clearly on the rise. We saw that confirmed in the Schedule 13 GA filings from around November 14th.
And for those who don't follow SEC filings, what's the significance of a 13 GA?
Sure. These are mandatory documents that show a large institutional investor, a hedge fund, a mutual fund, has acquired 5% or more of the company. When you see more of those filings, it confirms that large, sophisticated capital is accumulating the stock.
So the smart money is getting on board.
It appears so. They're validating the fundamental story of profitable growth.
That institutional interest is a perfect lead-in to the catalysts. What defined events are on the calendar for the next 3 months?
We have a pretty clear roadmap. First, investors have already been digging into the detailed Q3 earnings call from November 21st.
Looking for clues from management.
Exactly. Next up is December 8th. That's a huge date for ETF quarterly rebalancing. If the company gets added to, or its weighting is increased in a key fintech index, passive funds will be forced to buy.
Potentially creating a lot of demand.
A lot. Then in the new year, January 10th brings the top 13F filings. That's the first complete picture of which big managers bought in during Q3.
And the main event?
The big one is the Q4 and full year 2025 earnings report, probably around February 20th. If that report confirms a full, uninterrupted year of profitability, that will be a monumental catalyst.
Okay, so those are the known events, but the market loves to run on speculation. What are the big rumors out there?
Well, the juiciest rumor is around strategic M&A. The chatter is that with its healthy balance sheet, stock might be looking to acquire complementary fintech platforms.
To expand their footprint.
Right, maybe a specialty broker in a new country or some innovative tech. It would be a way to rapidly expand their product suite.
What about new products? Any rumors there?
Yes, significant speculation about an accelerated crypto trading expansion. Rumors suggest they could launch new crypto asset classes or even get into tokenized securities in early 2026.
That would open up huge new revenue streams.
Immense. And we're also hearing buzz about a possible major partnership with a large, established asset manager that could funnel a whole new cohort of users onto the platform almost overnight.
It sounds like the speculative side is all about growth, but we have to circle back to that regulatory speculation as the counterweight.
We must. The counter-narrative to all this growth is that regulatory scrutiny will finally crystallize. Some observers think concrete restrictive new PFOF rules could be announced.
And that would be a major headwind.
A major headwind against all of these growth catalysts. It would force the company to pivot its entire financial model much faster than they might be planning.
So let's bring this all together. What is the final synthesis here?
I think it's that stock is unequivocally proven it can transition from a pure growth disruptor to a profitable, scalable company. The Q3 results were exceptional.
And the next 3 months are critical.
Absolutely decisive. Full-year profitability confirmation and continued institutional buying are the key indicators to watch. If they maintain this momentum, the bullish trend is very likely to accelerate.
The long-term question for you, the investor, remains this. Now that stock has demonstrated it can beat the competition, can the platform successfully decouple its aggressive growth potential from its reliance on controversial revenue streams before regulators force the issue? That is the pivot we will all be watching.